Hello everyone, and welcome back to Dr. Tao's Quant Lab. Today, we have an absolute blockbuster lineup. We are stepping out of our standard format to bring you a special Mega 8 fundamental analysis session. What makes this session so critical is that all 8 of these companies have just released renewed financial reports. Their fundamental gravity has officially shifted, and we are recalculating everything in real time. We will be covering this titan alphabetically. Apple, Amazon, Google, Robinhood, Eli Lilly, Meta Platforms, Microsoft, and SOFI Technologies. Before we dive in, please note the disclaimer on the screen. This is an independent educational project. The views expressed are my own, and this is strictly for educational purposes, not financial advice. If you want to study the underlying mathematics of these models, please refer to section 1.7 of the main Quant Lab course. To understand exactly what the market is pricing in, we mapped out the stock's gravity using our valuation thermometer. Please feel free to screenshot these slides as we go through them so you can study these coordinates later. Here is how to rate the 3 core segments on our dashboards. Range 1, the blue box, is the deep value floor. This is the absolute worst case scenario, pricing based on strict forward estimates. If your stock falls in here, it is experiencing massive market capitalization. Range 2, the red box, is the expected target. This is our core fundamental fair value zone. The middle of this box represents the historical median multiple. If a stock has heavily stock-based compensation, we will also plot an orange box representing Wall Street's adjusted non-GAAP expectations. Then, the stat range, the purple box, is the micro-statistical boundary. This uses a mathematically normal 90-day standard deviation band to show us the immediate short-term algorithmic momentum. Finally, at the bottom of each matrix, we track 3 vital dates: the last report date, the next report date, and the statistical analysis date. Do not ever trade on obsolete data. Let's look at the charts. Kicking off our alphabetical breakdown, we have the anchor of the customer tech world, Apple, AAPL. They just refreshed their forward growth estimates to 9%. The current price is $280. Look at the extreme right side of the thermometer. Apple's fundamental expected target, or the red box, has strict mathematical ceiling of 269. Not only has the current price entirely outrun its macro fundamental fair value, but it has also violently broken above the absolute ceiling of its 90-day macro statistical momentum band, 271. This is the exact visual definition of stock priced for absolute perfection. The algorithms have dragged Apple into an overheated statistical extreme, fully detecting it from its updated earnings gravity. For momentum holders, this double breakout acts as glaring warning light. It is time to relentlessly tighten your trading stops, as the stock is operating completely without structural support at these levels. Next, we bring up the e-commerce and cloud titan, Amazon, AMZN. This chart provides a perfect example of a fundamentally supported breakout. The current price is 268. The black current price line has broken completely above the absolute ceiling of its 90-day micro statistical momentum band, 245. The algorithms are running extremely hot. However, because Amazon's renewed forward growth estimates are so structurally robust, this algorithmically overbought price is still resting comfortably inside its macro fundamental fair value, just below the median of 277. This is what true structural strength looks like. The short-term momentum is exhausted, but the price is not floating in an air pocket. It is backed by real earnings gravity. You can safely roll your trading stops up beneath that statistically ceiling and let the fundamental trend continue to work for you. Continuing with our renewed mega caps, we look at the search and advertising monopoly Google, Alphabet, GOOG. The current price is 383. Because Google's forward estimates have cooled steadily, the blue deep value floor and the red expected target are perfectly continuous. The current price has violently broken out above the absolute ceiling of its 90-day macro statistical band, 333. However, because the red expected target box stretches all the way up to 418, this overbought price is still technically embedded safely inside its macro fundamental fair value. This is a split decision chart. For short-term momentum traders, the math is flashing a major warning. But for long-term structural holders, the earnings multiple completely justifies the current price. It is structurally safe, but technically overbought. Stepping into the high beta fintech space, we look at Robinhood, HOOD. A few weeks ago, this chart was testing its limits, but the renewed earnings data paints a completely different structural picture. The current price is 73. Look closely at the overlap between the red expected target and the purple statistical band. The current price has dropped down to price on the -1 standard deviation statistical floor of $69. At the exact same time, it is nested perfectly into the lower half of its macro expected target, finding structural support right above the 65 fundamental boundary. This is a textbook momentum pullback safely caught by fundamental gravity. The stock is no longer overheated. The algorithms have washed out, but the forward earnings justifies this price point. For accumulation, this represents a highly logical entry zone wrapped in the safety of its historical fair value multiple. Stepping out of the tech and financial sectors, we look at the hypergrowth healthcare anchor, Eli Lilly, LLY. The mathematical convergence on this renewed chart is absolutely stunning. The current price is 963. Look incredibly closely at the left boundary here. The absolute floor of Wall Street's macro fair value is 928. At the same time, the absolute -1 standard deviation washout floor for 90-day momentum is 927. They are virtually identical. The current price has cooled off and is resting right in the lower quantile of both its statistical and fundamental ranges. When the statistical floor and the fundamental entry point form a perfectly aligned double bottom, you have incredibly defined risk. You are paying a premium multiple, but the math proves that premium is entirely justified by the massive forward earnings velocity. Returning to big tech, we turn to Meta platform, META. This chart provides a massive lesson in structural disconnects. The current price is 608. Look at the sheer distance between the current price and the red expected target box. Meta's earnings reset has pushed its fundamental fair value target up to an incredible 722 to 1,122 range. However, the current price is completely submerged inside its blue deep value floor. While washing out technically just a few dollars above its statistical momentum floor 605. This is a textbook deep value and statistical washout convergence. Mathematically, the market is pricing Meta at its absolute worst case scenario multiple despite strong forward growth estimates. For value accumulators, this offers a massive fundamental margin of safety. Next, we look at the fundamental titan itself, Microsoft, MSFT. The renewed data gives us a completely fresh look at their fundamental gravity. The current price is 14. The current price is tagged quietly into the upper echelon of its blue deep value floor, which caps at 420. At the exact same time, it is resting right on its 90-day macro statistical median of 419. Notice the air gap up to the red expected target box, which doesn't begin until $441. Seeing the price submerged inside the deep value floor, while statistical momentum remains perfectly neutral, is a rare and powerful convergence. The math tells us Microsoft has plenty of runway just to catch up to absolute bottom of its structural fair value. This chart is screaming fundamental safety. To wrap up our Mega 8 section, we examine SOFI technologies, SOFI. This chart provides a masterful lesson in identifying where algorithmic washouts meet structural fundamental support. The current price is $16. The current price has just cracked slightly below the absolute floor of its 90-day micro statistical momentum band, 16.55. The short-term algorithms have capitulated. However, look at where this washout landed. It is resting almost perfectly on the absolute bottom boundary of its macro fundamental fair value, which begins at 15.84. This is what a high probability mean reversion setup looks like. You are looking at a high growth disruptor at the exact moment statistical sellers are exhausted, right at the floor of its historical fair value. That wraps up our special Mega 8 post-earnings analysis. Today, we saw exactly why you must constantly recalibrate your models when fresh data hits the market. We mapped extreme overbought breakouts in Apple, beautiful structural mean reversions in SoFi and Robinhood, and massive fundamental runaway in Meta and Microsoft. The math never lies. It simply shows you what the crowd is willing to pay. It is your job to decide if the crowd is right. If you want to replicate this dashboards and run these models yourself, all the notes are in section 1.7 of the Quant Lab. Thank you for watching, and I will see you in the next section.